Hey there, my name's Curtis Lucas and you're watching Empire Building. In this episode, I'm going to be discussing the controversial topic of ultrasound money. What even is it? Why do Bitcoiners hate this so much? How bullish is this for Ethereum in the long term? And what exactly is this going to look like in Ethereum's future as we move from proof of work to proof of stake? Will Ethereum become deflationary? Is that a good thing? There is so much about this that a lot of people don't understand, and I've spent a great deal of time studying this from an engineer's perspective. And as someone who both believes in and supports both Bitcoin and Ethereum, I think I have a very unique perspective. I think it's important to distinguish what one is from the other in terms of staking and really this whole concept of ultrasound money versus the hard money promises that Bitcoin provides. So whether you believe in Ethereum or not, my intention is to provide you with an unbiased review. But make no mistake, this is coming from someone who does support this. I don't see this as evil. I do not see this as a scam. But I also don't see it as the answer to everyone's prayers. This doesn't solve every single problem there is. And it itself also has its own trade-offs and potential risks that it will need to deal with. So before we get started, it would be a really big help if you could just go down there and hit that like button below for the YouTube algorithm. Help let it know that people are interested in this topic and show it to more people. Because I think there's one thing we can all agree on is that more education is needed in this space. So, ultrasound money. What even is it? Well, you'll be sorely disappointed if you try and ask Webster because it doesn't exist. It's completely made up. This is one of Ethereum's memes. It was created really just to poke fun at Bitcoin. Now, you could choose to get all up in arms about this from that fact alone, but the fact of the matter is this space runs off of memes. I don't care if it's Bitcoin or Dogecoin. The sector of cryptocurrencies is powered off of memes. So from that assessment alone, I really think people just need to get past it. Now, having said that, this originated from the Bankless podcast. Originally started with a conversation with Vitalik Buterin, and he referred to it as ultrasonic money, which then became ultrasound money on a future interview with Justin Drake, I believe it was. So the entire idea was that if Bitcoin is sound money because of its maximum cap and its slowly depreciating issuance schedule. The fact that the number of ETH created into existence gets cut in half every 4 years. And it's very predictable how that's going to occur. Henceforth, also quite fair. This is called a hard promise. Something that is guaranteed and cannot be altered. And this is the mantra of Bitcoiners. This is why they like it so much. Bitcoin is all about hard promises. Immutability. It's a hallmark of Bitcoin's blockchain. It is the most immutable blockchain in existence. And really that takes it a few steps further because really what this whole concept of sound money is focusing on is just the issuance part of that. If Bitcoin is hard money because its issuance declines to zero over time, then Ethereum must be ultrasound money if its total supply actually begins to decrease over time. And this is pretty incredible because let's face it, there's nothing that's ever existed like this before. At least I'm sure there are other coins that have attempted something to this degree, but nothing on the scale that Ethereum's going to be doing it on. So that brings me to the question, what is it that will make Ethereum deflationary? We all know that EIP 1559 came out and initiated the concept of burning the base fee. Now, maybe not all of you are aware of that, but basically in that upgrade, that hard fork that Ethereum went through, the structure of transactions and in terms of their economics were changed. It used to be that transactions are processed by the miners. They select which transactions will be included in each individual block that they mine based on the transaction fees that users would attach to their transactions. That's how they get themselves to the front of the line and incentivize miners to include their transaction in the block that they mine. It's an open market and it works exactly the same way on Bitcoin. Now, in Ethereum, the question was raised whether or not miners were being paid too much for this service, for the security that they provide. Now, right here, we're getting into a deeper, darker issue on the relationship between miners and the Ethereum community versus miners and the Bitcoin community. In Bitcoin, there's not as much animosity between the community and the miners. Miners are revered, respected, and looked at as entirely necessary for Bitcoin's future success. Ethereum, it's not like that. Miners have been told from day one, you will not be needed very long, because Ethereum had always intended to get away from proof of work and begin proof of stake. But they weren't about to start this right from day one. Now, again, if you want to get mad at this topic and this topic or this issue alone, that's entirely fine. But all I'm pointing out here is that the two systems are very different. The communities are very different. I'm not saying one is better than the other, but they do serve different purposes. They solve different problems. And in another video, I can talk more about the difference between mining in Ethereum and mining in Bitcoin. But for now, just know that the communities are different. And for those of you that are wondering if whether or not this video is going to be worth sitting through, I highly recommend it, because near the end, I am going to be talking about how ultrasound money will drive Ethereum's price over a much longer period of time, say 10 years. But before we can get to that, I need to lay the groundwork here. And this is very important stuff. And I thought necessary to go through on a deeper level, because everything I've seen out there is either one-sided or just flat out wrong. And I'm speaking as an engineer. That's my background. An engineer who's been mining Ethereum for a number of years now. I took a look at Ethereum back in 2017 and recognized that there is a whole lot of potential here. So I mined the Ethereum that I would eventually use to stake and run a validator node, which I did, and launched that with the beacon chain on the Genesis block. On December 1st of 2020, I was a part of that validator community. So I've been active in both communities. I understand both sides of this argument in great detail. I find that even some of the developers, especially the developers on the Ethereum side, they don't truly understand or even appreciate mining because they don't do it themselves. They might run a validator node, but they're not miners. And to further clarify, I do support Ethereum's transition to proof of stake. I don't think it is necessary that everything be secured against proof of work. In my opinion, we don't need that because we already have Bitcoin. Bitcoin is incredibly important and serves an incredibly important role, but we don't need two of them. What we may need is a very strong, resilient, decentralized proof of stake blockchain. And now I realize as I'm talking here, a number of things I bring up are still going to get people upset because they already have preconceived ideas on the value of these two presumably opposing ideas. What I would like to propose is that you hold these two ideas in your mind at the same time. Try not to pass any premature judgments and just absorb the information. Once you understand them, then you can make a decision for yourself. So that's enough babble. Now let's get into the details. So this is a very useful website called Ultrasound Money. And there are a lot of very useful tools and metrics and real-time data on here. We can see what the projected burn rate of Ethereum is currently on the network based on the average number of ETH burned in each block to date, and then projecting that out over the course of a year. The current actual amount of ETH that's already been burned is approaching 500,000 already. For those that are wondering, that amounts to a total of almost $1.7 billion worth of ETH completely taken out of existence. Like having someone like Michael Saylor coming by and dumping $1.7 billion to buy up ETH that is never going to see the light of day again. So the immediate effect of that is that it lowers the overall issuance of Ethereum into the supply. The issuance of new ETH remains fairly constant. Every block, 2 ETH is issued and paid to the miners. So over the course of a year, that amounts to, right here, showing 5.4 million ETH per year. So as you can see, we are still inflationary. We're still growing the total supply of Ethereum. But by contrast, again, as we're showing here, we're currently burning per day almost 13,000 ETH every single day. And this number is going to be important here because for whatever reason, right now, network demand is quite high. There's another website that's quite useful that called Watch the Burn. You can see we just went through a significant spike. And I've been monitoring this for the last couple of weeks while researching this video. And these kind of spikes happen from time to time when network demand increases. For whatever reason, when a bunch of people decide they want to go and mint something, some new NFT, who knows? For whatever reason, from time to time, the network gets congested and fees go up. As we all know, this has been a frustrating reality on the Ethereum blockchain. So I'll move this picture down here for a second. You can see what these spikes look like. So going back to the other website, the 2.7 million per year, that amounts to an average of 7,400 ETH per day when averaged over the course of an entire year. So as you can see, it's not a constant rate and it can fluctuate wildly. And it has purely to do with the participants within the network. So it's not something that is a hard promise to compare that to Bitcoin. With Bitcoin, as far as issuance is concerned, you know exactly what it will be. With Ethereum, with this burn, currently, at least under the mining consensus algorithm, we have a fairly consistent, constant flow of new Bitcoin, but the amount that's getting burned is fluctuating. It's a little more volatile. So the total issuance now becomes a whole lot more unknown, harder to predict. So now the big question is, what happens when mining goes away? Because all of this ETH that gets produced and paid to the miners is completely removed. And all that remains is the ETH that is paid to validators in each block. And that is substantially less. Going down this website near the bottom, there's this very useful chart that you can actually manipulate to give you a little bit more perspective on how things might develop after the merge. And for those of you who don't know, the merge is when proof of stake will replace proof of work as the operating or the consensus algorithm of the network. Miners will go away. So when that happens, the amount of ETH that's paid to the stakers is based on how many stakers there are. Currently, the chart by default is set at 10 million ETH staked. Now, 10 million ETH works out to 10 million divided by 32, 312,500 validators. Currently, the network has reached little over 8.1 million ETH, and this chart is only reflects up to 10 million in total, which, as we mentioned, is a little over 300,000 validators. A lesser known fact is that written into the protocol is actually a limit on the number of validators that are actually allowed to exist. And that limit is 1 million. So we can't even go any higher than that. But of course, 1 million validators would account for 32 million ETH that would need to be locked up into staking. And that's nearly a third of the entire network. Now, that's not going to have much of an impact on the discussion that we're going to have today. I just wanted to point that out because it's one of the useful bits of information that I got out of the interview on the Bankless podcast. So the point I wanted to address here was that assuming 10 million ETH is staked, that results in 1,400 ETH being issued per day. But as I've just pointed out, the average issuance per year is already at, the average burn per year is at 2.7 million, which works out to about 7,400 a day. So we're burning several times more than we're issuing, and currently 10 times more when you consider how much has been burnt today alone. So what does that mean for the total supply going forward? Well, what it means is that supply could drop quite rapidly. So is this bullish for Ethereum? Sure is. Yeah, that's like a massive buyer who's constantly in the market, sucking up all of these coins and never selling them. So yeah, that has a massive impact on the economics of this asset. So the question is, where this video is headed is how massive, but also what are the consequences of this decision? What could be the long-term effects as this plays out over the next 10, 20, or even 30 years? Assuming you believe that this will still be around then. Me personally, I do. So we have to make a few more assumptions here, and we're going to use this chart. Right now, they assume a merge date of March 30th. Honestly, I do not think it's going to take that long. By March 30th, the block time as a result of the difficulty bomb will be egregiously high. So if it takes that long, we really have only two options. Either delay the difficulty bomb again or convert to proof of stake earlier. I'm of the opinion that we will convert to proof of stake significantly before this date. No later than the end of January if we don't want to delay that difficulty bomb yet again. And from what I can see, there is nothing preventing us from doing that. Again, we'll talk about that in another video. Let's just try to keep on target here. So for starters, I am going to set this to the end of January or February 1. That's close enough. The next is the fee burn. Currently, it's set to show at 5,000 per day. Currently, on average, we're doing 7,400, but that average has been going up. But for the lack of a better alternative, I'm going to set it at 7,400. So that indicates how much Ethereum is being taken out of circulation and burn. I'm going to leave the staking amount at 10 million. We still have a long way to go to get there. So at least over the next year or two, who knows? The reality is, when looking back again at this launch pad, the current APR sits at about 5.5%. By the time we get to 10 million, it'll be just below 5%. I'm of the opinion that the incentives and disincentives at that point for more people to join start to diminish unless people can find a better place to put their money. We'll have to see what happens. But the point is that as you increase that number, the effect it has on the network starts to diminish. So starting with 10 million ETH stake, total issuance is at 1,400 per day and total burned at 7,400 per day. So 6,000 ETH every single day taken out of circulation, dropping the total supply. Now, what this leads to is approximately 2.9 million ETH being burned out of existence within 1 year, the first year. And if this continues, 2.9 million burned every single year, continuing to drop that overall supply. So the question is, well, how long can that go on for? I mean, eventually you're going to burn all the ETH, right? Well, before we go too far, it's worth noting that it would take approximately 34 years to burn enough ETH for the total supply to reach that same magic 21 million number that Bitcoin currently targets. But it wouldn't stop there. It would continue to drop. And this brings us to a bit of the crux of the issue. How long does this go on for? But also, is it actually constant? I mean, I've already mentioned that this burn rate fluctuates. You don't actually control it. It's certainly not constant. Sometimes it could be more than that. Sometimes it could be less than that. Sometimes we could even find ourselves in an inflationary state again. There's really no telling. We won't know until this has been running long enough. Not to mention, we also have to address the fact that Ethereum is going to scale substantially. And when scaling occurs, then those transactions fees will diminish. But we don't know by how much. And we also don't know what effect increased demand would also have on those overall fees. There's a lot of moving parts here, and nobody can say with absolute certainty how this is going to play out. And this plays back into the issue that some Bitcoiners legitimately take with this entire idea. Bitcoin's hard promise is that 10 years from now, 20 years from now, 30 years from now, 100 years from now, they know how much Bitcoin will be in existence. With Ethereum, nobody can say that. Nobody knows. Now, based off the information that we can see, I think it's pretty evident that we will see Ethereum become deflationary overall. But for how long can it sustain that? Certainly between now and 100 years from now, likely something is going to change. We just don't know what. And we also don't know what the consequences of that will be. People think that these decisions are made by a small group of people and no one else has any say. And that is not true. Yes, these decisions can be made by a small group of people, but it's completely false that no one else has any say. The reality is, when a decision is made to fork Ethereum, there's always a risk that a group within the community will disagree in substantial enough numbers that they'll fork the blockchain and create an entirely new chain. It's already happened. That's how we got Ethereum and Ethereum Classic. Even if you have an overwhelming majority of support, you can still fracture that community. And Ethereum developers and insiders, or whoever you want to call them, they have to contend with this issue. And while they certainly didn't get any pushback by introducing this ultrasound money in the first place, if they ever try to take it away, well, that's going to be a different issue altogether. Especially since by that time Ethereum would presumably have grown substantially from where we are now, including people from many different walks of life with many different viewpoints. Forking that kind of change into Ethereum's consensus algorithm at that time could be extremely difficult and will most likely lead to a fork. But we're talking potentially decades from now when Ethereum could be far more valuable. So as far as a imminent risk from an investment point of view, it doesn't bother me, not at all. And whatever happens, whenever that happens, we'll deal with whatever it is. And even if it forks, well, anyone that's an existing investor gets both coins anyways. That's what happens in a hard fork. So long as you actually hold your own coins, you get both of them, as long as you've got the keys. So if you're holding your coins on an exchange, nope, you don't get them. The exchange does. Unless they choose to give them to you, well, that's up to them. So not your keys, not your coins. So I'm sure by this point I've already lost many people who are perhaps even more confused than when I started. This sort of trying to understand this technology is there's no straight line path. It's something you just have to dive into. I just mentioned the word hard fork, and I can recall when I got started in this wondering, what the hell is that anyways? What is a hard fork? What is a soft fork? I don't have time to set up the definitions for these ideas in every single video. But as time goes on, you sort of start to absorb these things. And the more you hear about them, the more you absorb those ideas and gain a better understanding. But it's especially difficult when a lot of the information out there is coming from other sources that frankly are misinformed. I noticed a shocking example of that when I reviewed the definition of staking on Coinbase's website. And their definition is consistent with how Cardano institutes staking, but is completely off base when looking at Ethereum. But they don't distinguish between the two. Again, I'm not going to get into that entire issue, but again, you have to be careful where you get your information from. And the only way to really sort through all of that is to listen to multiple sides, to try to look at it impartially without bringing into the conversation any preconceived ideas. So I hope that clears things up somewhat, and you understand how this might play out and why it's very good for Ethereum's economics, tokenomics, and very bullish for the asset long term. So now for the fun part. In a previous video, I had described how by the end of next year, I expect Ethereum to grow in market cap to surpass that of Apple's current market cap, which would deliver an Ethereum price target of just about $20,000 US. But the way I see it, why stop there? Why not actually imagine a world where a lot of this stuff really starts to play out? And what might it look like, say, in the year 2030? We're talking 8 years into the future, at least post-merge. So continuing with the assumptions that I had made earlier, that Ethereum's overall supply could drop by 2.9 million ETH every single year over the course of 8 years to get us to the year 2030. And as Ethereum's ecosystem continues to expand, after 8 years, Ethereum's total supply would have been reduced by 23.2 million. That would bring Ethereum's total supply down from about 119 billion down to 96 million or so. And similar to my argument regarding Ethereum's potential market cap by the end of 2022, by the end of 2030, I expect Ethereum would easily, without much difficulty, surpass the combined market cap of all the FANG stocks. We're talking Facebook, Amazon, Apple, Netflix, and Google. Currently, they have a combined market cap of almost exactly $7 trillion. To be honest, I don't think this is going to be that much of a stretch, and it certainly doesn't account for any hysteria that also may occur. So while there's a lot of assumptions made in this, and as you do when you're looking 8 years into the future, you can get a whole lot wrong. But as a thought exercise and sort of a best guess proposition, this is about as good as it gets, as far as I'm concerned. In the end, you can make your own assumptions and see what number you come up with. But in the end, what you get when you take $7 trillion and divide that by 95.9 million ETH, you get a total of $73,000 US. Now, obviously, I somewhat clickbaited in the title, suggesting it could go up to $100,000 US, but at this point, that's within a margin of error. Because let's face it, I've also based that on the current market cap of the FANG stocks. Assuming they're still around, who knows what that could be in the year 2030, and who knows where everything else is going to be in terms of the US dollar and all the other macro forces that are at play in these ecosystems. So the point is 73,000, 100,000, hell, it could be 200,000. Point is, it's substantially greater than we are right now. And by comparison, without the burn, that same $7 trillion market cap would result in a price of about $58,000 or $59,000, $58,704 to be exact. That's the effect of the burn. So it does have a big impact. And I should note that that's also only based on Ethereum's current supply. So that's basically assuming that we reach this max supply and it flatlines from there. If Ethereum was still somehow running on proof of work and the same issuance, it would be substantially higher, and thereby diluting the existing holders of Ethereum. So in the future, we can have more of a discussion about whether or not any of this makes any sense, whether it will be successful. There is so much to dive into on these topics. But as I continue to do that on this channel, I'm going to do so from a fair and balanced perspective. Someone who both admires and respects the technology behind Ethereum and the technology behind Bitcoin. And the way I see it, these two will exist synergistically. They will rely on one another. They're not competitors, they're more like wingmen. Bitcoin's hard money promises may be just what Ethereum needs for it to reach full scale. And likewise, Ethereum's trade-offs for efficiencies may be just what Bitcoin needs to provide all of the promises that got most of us excited about this technology in the first place. I don't think either one could truly be successful without the other. They need each other. And as communities, I would really like to see us put our differences aside and focus more on what we have in common. Stop pitting us against each other. It's not necessary and it's counterproductive. So if that's something that you agree with, then subscribe to the channel, because this is what we're going to be getting into. And there are so many layers to this. Share your thoughts down below and let me know what you think. And subscribe to the channel and hit the notification bell so you don't miss any updates for future videos. That's all for this one. Now let's get back to empire building.